Every once in a while, a single number gets released that completely rocks the financial world. Well, today, we're digging into one of those moments. We're talking about a piece of economic news that, on the surface, looked absolutely fantastic. But when you peel back the layers, well, it turns into one of the biggest statistical mysteries of the year. So let's get right into it.
And here it is. This is the number, 2.7%. On December 18th, 2025, the U.S. government dropped this figure as the annual inflation rate for November. Now, for most people, that sounds great, right? A huge win in the fight against rising prices. But for Wall Street, this was an absolute bombshell.
And this chart shows you exactly why. The market, I'm talking all the experts, the big banks, the economists, they were all banking on an inflation number around 3.1%. The actual result wasn't just a little bit better, it was a massive positive surprise. It completely blew expectations out of the water. The stock market, of course, went nuts. But as that initial euphoria started to wear off, a really serious question began to pop up.
Yeah, was this number just too good to be true? Because hiding behind that amazing headline is a story of total chaos, missing data, and some very weird statistical quirks that make this one of the most complicated and, yeah, potentially misleading economic reports in a long, long time.
So our story starts with that fantastic number, but its origins are messy. And it all begins with something that literally paralyzed the US government, a historic shutdown that just threw everything into complete disarray. For 43 straight days, the longest government shutdown in US history brought federal operations to a dead stop. But here's the really critical part for our story. That second point on the timeline, for the entire month of October, the agency that actually collects all this price data, they collected nothing. Zero. A complete and total data blackout. It created what you could call a statistical black hole. And this is the real kicker. The agency itself confirmed they couldn't get that data back. It wasn't just delayed, it was gone forever. I mean, think about it. You can't just go back in time and check the price of 80,000 different items from last month. And that one single fact compromises everything that came after. This whole situation actually has a name, data fog. The best way to think about it is like you're trying to drive down a highway at full speed, but your windshield is totally fogged up. You can kinda see the vague shape of the road, but you have no idea if there's a huge pothole or some other obstacle right in front of you. Well, that's exactly the spot the Federal Reserve and economists are in right now. So how did this data fog go from just obscuring the picture to actively distorting it? Well, that's how we ended up with a headline number that looked so good on the surface. Okay, so if they had no data, how did they even put out a report? Well, they had to use an emergency method. See, normally they collect price data nice and evenly all through the month. But this November, because of the shutdown, they only started collecting data on November 14th. So what, right? Well, it matters a lot. Because that means they almost exclusively captured all the early Black Friday and pre-holiday sales, the exact time when prices for tons of goods are at their absolute lowest. And hey, don't just take my word for it. Analysts over at Goldman Sachs actually ran the numbers and calculated that this timing bias alone probably made inflation look 0.1 to 0.15% lower than it really was. They literally called the result a methodological mirage. A huge chunk of that good news, it might just be a statistical illusion. But the weirdness doesn't even stop there. Let's move on, because if you dig into the report, you find an even bigger puzzle, especially when you think about one of the biggest economic stories of the year. The trade war and all of its tariffs. This is the big mystery right here. We're always told that tariffs are basically a tax on stuff we buy. Logically, that should have pushed prices up, especially for things like clothes that are mostly imported. So you look at this super low inflation number and you have to ask, where is all that tariff inflation? The answer seems to be that the impact isn't gone, it's just delayed. And there are three big reasons why. First, a lot of retailers were smart and stockpiled a bunch of goods before the tariffs hit. Second, a lot of big companies are actually eating the extra cost themselves, squeezing their own profits to avoid scaring you, the customer, away with higher prices. And third, like we just talked about, the holiday sales captured in the data are masking the underlying price pressures. It's like a dam holding back a ton of water. The pressure's just building and building, and it's probably going to break loose in early 2026. And this table just perfectly illustrates the conflicting signals that are hiding inside the report itself. The overall number is low, sure, mostly because housing costs are slowing down and apparel prices are actually falling. But look over at energy. It's accelerating up a pretty worrying 4.2% over the year. So that low headline number is hiding the fact that essential costs, like heating your home or filling up your car, are actually surging. So you've got this flawed, contradictory, foggy report. How in the world did the financial markets react? Well, it was a tale of two very different markets. It really depends on where you were looking.
The stock market saw the words low inflation and just smashed the buy button. It was pure euphoria, a rocket ship fueled by the hope that the Fed would start cutting interest rates. But the bond market, which people often call the smart money, was way more cautious. Bond traders looked at the data fog, at the tariff paradox, and basically said, whoa, hold on a second, let's not get ahead of ourselves here. They're playing the long game, looking for the truth.
And that caution is totally reflected in what the market thinks the Federal Reserve will do next. Even with that shiny 2.7% number, an overwhelming 76% of investors are betting the Fed will see right through the noise and just hold interest rates steady in January. They know the Fed can't risk its credibility by making a huge policy decision based on such flawed, foggy data.
So this brings us to the big finish. How do we make sense of all this? How do we navigate through this statistical fog to figure out what's really going on with the economy?
I think this quote from the original analysis just sums it up perfectly. A Pyrrhic victory is a win that comes at such a massive cost, it's basically a defeat. That 2.7% number is technically correct, sure, based on the emergency rules they had to use. But it's so incomplete that it tells us almost nothing reliable about where we're headed. So what are the big takeaways here? What do you really need to remember? First, the good news is inflation is probably trending down, but that 2.7% number almost certainly exaggerates it. Second, that price shock from the tariffs, it's still coming, probably in early 2026. Third, you can bet the Fed is going to play it safe and wait for cleaner data. And finally, and this is the big one, it means the real economic test hasn't even started yet, which leaves us with one final question. After peeling back all the layers of this story, the shutdown, the data fog, the hidden paradoxes, what do you think? Is this 2.7% number a sign of a real, genuine economic victory? Or is it just a beautiful but ultimately fake mirage in the desert? It's a lot to think about.